All right, you are welcome to today's lesson. We are going to look at one very important subject today, which is financial accounting. Financial accounting is one of the subjects that is required by WAEC under the secondary school curriculum. Now, under that, we are going to look at a very important topic. It is trading profit or loss account. I say trading profit or loss account. If you check the topic, you see that at the end of trading, there is a comma there. Trading, comma, profit or loss account. That means we are going to look at two different accounts put together. In some other textbooks, you see something like trading profit and loss account. But you know that in a business, you cannot make profit and make loss at the same time. So you either make a profit or you make a loss. So there is a modification on this particular topic. It's no longer trading profit and loss account, but trading profit or loss account. Under this topic, we are going to consider what we call learning objective. What do we intend to achieve at the end of today's lesson? We are going to look at three very cardinal points as our focus in our today's lesson. Number one, we are going to look at how at the end of the lesson we can define trading account and profit or loss account. Number two, we are going to identify those items or those transactions that one can easily find under trading profit or loss account, and then we are going to see how we can solve related problems. Now, at the end of the day, if we are able to define trading account and profit or loss account, identify the items, those transactions that are expected to be found under trading, profit or loss account, and solve related problems, that means we have achieved our purpose. Now, let's go with the definition. When you hear of the word trading account, what are we talking about? Trading account is simply an account that is prepared to ascertain profit or loss, gross profit or loss for the period. You see, the question is it just gross profit that is expected to determine in trading account? Yes, we have some other accounts that are prepared for other purposes. But for trading account, the only reason why we are preparing trading account is that we want to ascertain gross profit. And then, you ask me, how can somebody determine gross profit on a trading account? It's a very simple process. What do? You look at, because on a trading account, there are transactions, like I said earlier, that will determine whether you are making a progress or you are not making a progress. So what you should do is that in trading account, for you to determine your gross profit, you look at the difference between your net sales and the cost of goods sold for the period. I know at this point, hearing net sales and cost of goods sold for the period will sound so ambiguous because I have not explained these transactions. But as I make progress, I'm going to take time to explain what net sales is and what cost of goods sold is. But meanwhile, I want you to understand that there is how to get your gross profit is simply to compare your net sales and your cost of goods sold. Then, gross profit trading account has two very outstanding division. We have the debit side and then the credit side. The debit side is basically what comes into your hand as you are carrying out the trading activities, and then the credit side is what goes out of your hand. Basically, what you can see on the credit side is just the sales and then goods that is returned by your customers. We call it return invoice. While on the debit side, you see the likes of opening stock, purchase, and so on and so forth. I am coming back to them as we make progress. Now, I said I was going to explain items of trading profit and trading account. Now, the first thing we have here is opening stock. What is opening stock? Opening stock is simply stock at the beginning of the period. What are you selling? What are you into? What are you known for? Every business is known for a particular thing. If you are into the baking of bread, bread is what singles you out. If they want to talk about companies that make bread, if you are known for bread baking, then you will be known for bread. So bread could be your product. So that product you have at the beginning of the business becomes your opening stock. Then purchase. Sometimes as you begin the business, you may not have enough stock to sell. So there will be need for you to go to the market to procure or to buy or to acquire more. So the process involved in going to the market to buy more is what we call purchase. And then going to the market to buy this product, it maybe in the process of bringing that product down to the destination of your business, there may be some cost, or there may be some, there may be some expenses that you will incur. Now, so the cost or expenses incurred in bringing the product from the place of purchase to the destination of your business is what we call carriage inwards. Then return outwards. If you buy products, sometimes in the place of purchase, you may not have all the time to begin to check all the products you have purchased so far. So by the time you get to your shop, you will now take your time to verify the product that you have bought. So in course of verification, there are some products that may not meet up to standard. We call it defective goods, or goods that doesn't meet up to standard. This particular product needs to be returned back to the seller. That product that is returned back to the seller, it is called return outwards, and it must affect your purchase. If, for instance, you are into bags, you are selling maybe bags of slippers, or you are selling slippers, and then you go to Ariara market to get maybe 3 or 4 bags of slippers. It's expected that every slipper must come with must be in pairs, left and right. Now, bringing it to your company, you now see that a bag is just left. You may not be able to sell because your customer will want to buy a pair, left and right. That particular bag doesn't meet up to your expectation. So you have to send it back to your supplier. So that goods that is returned back to your supplier is what we call return outwards, and it must be subtracted from your purchase. The next one is what we call closing stock. Closing stock is a stock of goods at the end of the period. Now, at the end of the period, you may not be able to sell everything from what you have at the beginning and what you've been able to buy. You may not be able to sell all. So the ones you could not sell constitute your closing stock. And then there is what we call cost of goods available for sale. Please don't forget what I'm trying to do. I'm just trying to give you a rundown of the transactions that one can find in a trading account. In this lesson also, I will give you a format. So you will begin to see how these transactions relate with each other to form a working trading account, because they are not just on their own the way they are shown on the screen. They interact. There's a correlation between them. Opening stock relate with purchase, like that and like that and like that. So going to cost of goods available for sales. Cost of goods available for sales is just the goods that is available. How do you arrive that this particular transaction is deduced or is derived on the trading account? You cannot see it as a transaction on its own. It's something that you arrive at when you add your opening stock to your net purchase, and then you arrive at what we call cost of goods available for sales. And then cost of goods sold is what you get when you subtract your closing stock from cost of goods available for sales. Then sales is the cost of the goods that is active actually sold out. Let me explain this a bit, because students usually find it very difficult to understand the difference between cost of goods sold and sales. Now, sales is simply the actual goods that is sold out. If I have 10 bags of cement as a product in my shop, these 10 bags of cement, let me assume that the cost of each of them is 2,000, about 20,000. If I'm able to sell 5 bags, 5 times 2 is 10. That's 10,000. That 10,000 is the sales. Now, what is the cost of these goods that is sold out? Let me assume I bought one of them 500. I'm going to multiply that 500 by the 10 bags that is sold out. So that 500 times that 5, it will give you 5,000. So that 5,000 is what is actually the cost of goods that is sold out. Meanwhile, the sales is the original, is the sales is the selling price of the goods that is sold out. And then the second to the last is what we call return inwards. In return inwards, just like I explained in return outwards, return inwards has to do with goods that your own customer return back to you. You sold some goods to your customers, and then at the end of the day, just the way you discovered that some of your goods didn't meet up to expectation, and then you send it back to your customer, to your supplier rather, that is how your own customer can also return goods that you have sold out to them back to you. So when this happened, whatever you have sold, that is going to affect your sales. I was using cement. If you sold out 10 bags of cement and your customers return 2 bags of the cement to you, probably because getting to their shop, they discovered that 2 bags is no longer good. Those 2 bags will be subtracted from your sales. And then the next one is what we call gross profit, which should now be the very essence of the trading account. The gross profit at the time you have arrived at that gross profit, you have completed everything about trading account. Then the gross profit, like I said earlier, is simply the difference between your net sales and your cost of goods sold. Now, the next thing to consider is profit or loss account. I said earlier that today's lesson is trading, profit or loss account. 2 accounts, put them together. I have been able to wrap up what a trading account is, how it should look like. And then very quickly, we want to also peep through profit or loss accounts. The emphasis here, like I said from the beginning, is how to be able to define this account and then solve related questions. Please don't forget that, because we are coming back to that at the end of the class. I will want to see if we'll be able to define this account, and then we can memorize the transactions that could be found in this account, and then finally solve related questions. Now let's look at what profit or loss account is all about. Profit or loss account, as defined here, is an account that is prepared to ascertain net profit or loss for the period. Somebody should ask me, what is the difference between net profit and gross profit? Now, net profit is the profit that you realize after you have charged expenses incurred within the period. Expenses incurred within the period. Are we saying that when we were doing trading account, there was no expense? There was. But the difference between the expenses that will determine your net profit and the expenses that will determine your gross profit is that in net profit, those expenses are called service charge. These are transactions that will reduce your profits. Example, we have the likes of electricity. You pay electricity bill. We have what we call house rent. We have what we call salaries and wages. These are necessary payments that you must do if the business must move on. You cannot escape them. And once you incur this, it will affect your net profit. So your net profit is simply the difference between your gross profit and your total expenses. And then we say income or gain is credited while expenses are debited. In this case, you see that expenses are debited and income or gain will be credited. I have said earlier that these accounts, they are divided into two, two equal half. One on the debit side and the other one on the credit side. When we are looking at trading account, we said that whatever enters our hand, it will see it on the debit side, and what goes out is on the credit side. Now, the same thing with the profit or loss account. Whatever enters your hand is on the credit side, and what reduces what you have received is on the debit side. It will observe this is based on the double entry principle. Before I forget, I want to remind us that every account is prepared based on the double entry principle. That principle simply states that for every debit entry, there must be a corresponding credit entry, and vice versa. So if you transact a business, and then in course of transacting that business, something entered into your hand, that value that entered into your hand must be debited to your account, and whatever you did to earn such benefit will be credited, because something must go out for something to come in. All right, now I also want us to look at it. He said the difference between the credit side and the debit side is the net profit or net loss. Now, that's what I have been explaining, that when you compare your gain, what you have received and what goes out, the difference between both of them becomes your net profit or net loss. Now, let's quickly look at items of profit or loss account. There are items, there are transactions, just the way we looked at transactions of the trading account. We have expenses. I've explained what expenses are. I said these are compulsory payment, or these are service charges, things you must do. Like we have wages and salaries here, we have transportation cost here, we have carriage outwards here, we have discount allowed here, we have bad debt. They are very, very uncountable. But there's something unique about expenses that I want to bring to our notice, because students are fond of being addicted to a particular pattern. Accounting is one subject that students should be very, very flexible with, because no two companies can have the same expense. Somebody that is into maybe a baking of bread, like I said earlier, and somebody that is into the sales of shoes may not have the same expense. As the person that is baking bread will be looking for how to get flour, how to get water, and all of those things that will constitute the production of bread. The person that is into sales of shoe will be looking for how to go to maybe Ariara market, or how to go to Lagos, how to go to all those spots where they can buy shoes on a very cheaper and affordable cost. So the expenses may not be the same. So that is why anytime you want to talk about expense, you cannot exhaustively list them. But just bear in mind that whatever reduce your gross profit becomes your expenses. Then the next on the other side of the account is the income or gain. We also have different things that can become income, or that can increase the value of a company. Now, the first one here is gross profit brought down. This gross profit brought down is the profit we have realized in our trading account. The profit you realize in your trading account will be brought down, and then expenses will not be charged on it. Now, in the process of transacting business, there's what we call discount receipt. When it comes to this particular part of the account, there's something I usually tell students. I will tell you that how to be able to understand the difference between this income is just for you to know that there are times when you can earn an income, but you don't receive. And there are times when you can receive income you don't earn. Let me say that again. You can earn an income that you don't receive, and you can also receive income you don't earn. What do I mean? When you work for somebody, you are working in a company. At the end of that month, or at the end of the month, you are expected to be paid salary. That salary that you're expected to pay, once you are paid that salary, is an earned salary. That income is an earned income because you worked for it. If for any reason the salary is delayed 1 month, 2 months, and you are not paid, that income is an income that is earned but not received. But if you are into a business and then somebody call you and say, please come, you have been a very committed and very reliable customer. I want to start giving you my product at certain terms and conditions. Now, if you buy 10 cartons of Indomie from my shop, please pay for 8 and let go of 2 cartons. That kind of provision that is given to you is called discount. That discount is what you don't earn, but you receive it. You don't earn it, you don't deserve it. Tomorrow the person can wake up and say, I don't want to do again. If the person chooses not to do it again, that means at that point it has, and because you didn't work for it. Even if the person will want to make you feel it is justifiable to be given, they will tell you are committed, but there are some other persons who could be more committed to you who are not giving the discount. So at that point, that income that you receive is not earned. So every income that is received that is not earned is grouped as income that should be added to your gross profit. As you can see on the slide, you see gross profit, you see discount received, bank interest, reduction in provision for bad debt. Now, we are gradually getting to the end of the theoretical framework of this topic, because this topic is basically best described and explained with illustration. So I just want to wrap the theoretical framework, and then we look at examples that will really bring the message home. Now, when you talk about an account, there is a part of an account that is very fundamental and important. It is called the heading. You see, an accountant doesn't look at an account without considering the heading. The heading of every account is as important as the account. It's just like you going to the classroom without writing the name of your subject on your notebook. You are doing 20 subjects in a class, and you refuse to write business studies on this one, basic science on this one, or you refuse to write chemistry on this one, physics on this one. It will be difficult for you when the teacher is coming to class to sort out these books. How will you be able to differentiate chemistry note from physics note? That is how it is with account. Every account that does not have title can actually be difficult for the accountant to assess it. So every account must come with title, and trading profit or loss account is not an exception. So the title of this account, as you can see from the screen, is that the title should, it says, since it contains the result of operations of a business over a period, the heading should be trading, profit or loss account for the year ended, blah, 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 blah. Those dash there represent a particular period. So every account, every title must carry 3 fundamental information. 1, the name of the account. Which account are you preparing? From this title now, you can see that the name of this account is trading profit or loss account. Now, the second thing is the period. Okay, the second thing is the owner of the account. Who owns the account? Who are you preparing? In whose name are you preparing the account? You know, you can ask me, sir, but this one does not have any name. Yes, because this is a lesson. If you want to prepare it in the name of a company, the name of the company will be clearly stated. And then let me assume we are preparing this they are preparing this lesson in the name of Sigmatech. If Sigmatech is what we are using as the company we are preparing now it's going to look like trading profit or loss account for Sigmatech Nigeria Limited or Sigmatech Consult Limited, and then you now have as at 31st December a particular year. That's the way it should look like. So anybody that want to look at the account can easily know that, okay, this account is prepared in the name of Sigmatech, and then it is prepared within this period. That is how the title of an account should be prepared. Now, having said all of this, how does trading profit or loss account look like in real life? At this point, I will want us to take a journey to the board where I will just give you a rundown. This is going to be a sketch of how the trading profit or loss account should look like. But what I want to tell you is that we have two ways this particular account can be prepared. The first one is called the T method, and the second one is called the vertical method. But please permit me to use the vertical method at this point, or probably let me use a T method because I've been talking about division. So you will be able to appreciate the beauty of what we are doing. So right now, I'm going to give us a format. So I'm going to write, I'll divide my board into two equal parts, and then I'm going to concentrate on one part here. So I'm going to write the format of trading profit or loss account. So I want to let me use my name. Let me use my name. Let me open this account in my own name. Or let me choose a company. Let's just choose a company ABC. So we are going to choose a company ABC. So we are opening this account in the name of ABC Limited. So we are going to say trading profit, or loss account of ABC Limited as at 31st December 2022. This is how it will look like. And like I said before, it will be divided into two. This is why we call it T method. I told you we are going to be using T method. Trading profit or loss account of ABC Limited as at 31st December 2022. So like I said before, this is your debit. We have put your D arrow there, and then this is your credit. Now, the next thing is you are going to ask yourself, which particular currency are we using? We are Nigerians, and then we want to use our currency. So because we are using our currency, you don't forget your Naira sign. I usually advise students to use a double Naira sign. One is for adjustment, and the last one is for the real figure. So the Naira sign here is what we are working with because we are Nigerians. That is our currency. So the first thing that should be here is opening stock. Opening stock, we have to come here because this is the stock of goods at the beginning of the period. It has no adjustment. Now you add your purchase. Your purchase will be here because, like I explained earlier, your purchase comes with adjustment. There are some things that will be added and be subtracted. Things like carriage inwards. Carriage inwards. And then when you add this to this, you have a value here. The next one is returns outwards. Returns outwards. This return outwards, we are subtracting return outwards. Sorry, I have to indicate that we are subtracting. So it is called less. In accounting, when you see add is addition. When you see less is subtraction. So you say less return outwards. Sorry, the writing may not be legible enough because I'm trying to manage the space. But bear with me. What we have here is return outwards. So when you subtract this from here, you have a value here. This value is what we call cost of goods. Okay, before you call it that, this value will now be added to this one. This is what we call net purchase. Please let me write it in such a way that you will appreciate. This is your net purchase. Net purchase. Because there are some exams in WAEC, in objective, they might want you to find out your net purchase. So your net purchase is simply your normal purchase plus carriage inwards, which is this, and then you subtract your return outwards. When return outwards is subtracted from this value, you have your net purchase. So your net purchase will be added to opening stock to give you your cost of goods available for sales. Cost of goods, I'm going to shorten some of the writing. Cost of goods available for sales. Now, having arrived at cost of goods available for sales, the next thing is how to now determine your gross profit. But before then, you now have to subtract less your closing stock. Your closing stock will come here, and then when this is subtracted from here, you have what we call cost of goods sold. I know I've explained all of this, what cost of goods available for sale is all about, what closing stock is all about, and what cost of goods sold is all about. Now let's look at sales. Here is a part of the account that takes care of your sales. So your sales come here. Sales doesn't go that way because you have return inwards. So you have your return inward, you have your sales value here, and then you subtract what your customer return back to you, which I call return inwards. And then when this is subtracted from here, you have a value that is here that we call it your net sales. So your gross profit here is simply the difference between your cost of goods sold, which is this value, and this value, and your net sales. So when you subtract here from here, you have a value here, and then this value will be added to here to give you what we call the total of your account. And then don't forget, at the end of every account, you have to double the line. So this is how to achieve, or this is how to prepare trading account. This is the end of trading account. So since we call it trading, profit or loss account, the account will not end there. If you were asked to prepare only trading account, this is where you get to, because you have gotten your gross profit. But because we are preparing two accounts together, you are going to continue with profit or loss account, and then continue with profit and loss account. Your gross profit will be brought down this way. So you write your gross profit brought down. That's this value. It will be here. Be written directly under that total column. And then your operating expenses. Your operating expenses comes here. Your operating expenses include all those expenses that we listed before. The likes of transportation. Can we just do a continuation on this other side of my board? Let me continue with what I'm doing just to explain better. You have transportation. Permit me to write transport. We have carriage outwards. We have salary and wages. And then, and so on and so forth. And then, when you add up everything you have here, you have a value here called your total expenses. This is what we call your total expenses. And then, for here, you have what we call discount received. That will be added. It will be added. We have interest on deposit. And then we have what again? We can also have decrease in provision for bad debt, etc., etc. So when you compare, you add up all this with this and compare it with what you have here, at the end of the day, the difference will now give you your net profit. So your net profit, which will come here, will now be the difference between what you have here and then what you have that way. And the difference between them will now give you your net profit. So that's a brief sketch of how a trading profit or loss account should look like. This is just a sketch. Like I said from the beginning, the emphasis is how we'll be able to now use this knowledge we have acquired to solve related questions. We have defined it, we have looked at the items, and we've also looked at the format. At this point, we want to now make progress into some related questions. There are some questions that will now give us a clear view of what we have done so far. So what I'm going to do at this point, we have a questions already, but what I'm going to do, I'm going to center this on, I'm going to go to some exam guide. So having explained and then giving the description of how it should look like, we are going to take some past questions from exam guide that will serve as that will be used to explain better what we have discussed so far. All right, we have. Okay, let's look at what we have here. They say use the following information to answer this question. We have sales, 183,400. We have purchases, 168,000. We have opening stock, 20,000. We have closing stock, 48,900. Carriage out was 2,400. Carriage in was 5,000. Return in was 10,000. Expenses 15,000, and return out was 8,000. The first question is the gross profit is, all right, let's use our board. At this point, I want to clean the board so we can have space where we'll be able to solve this. All right. So let's look at the question. We have an exercise here. Even if it is objective, we want to see how we'll be able to provide solution to this problem. Now, from this question, you've been given sales, you've been given purchases, you've been given opening stock. All the transactions that I have mentioned so far, at least they have given us the information. It's just for me now to now use what we have discussed so far, the knowledge gotten from what we have discussed, to provide solution to this. So now, because this is OBJ, I'm not just going to teach you how to be able to answer this question, but I'm going to teach you how to manage your time. Now, if you look at this, they said the gross profit is, so what you need to do now is, if you want to use the T method I taught you just now, what you just need to do is just to draw your T method like this. You don't even need to write the title because nobody is there to mark your work. It's just, this is going to be a rough work that you're going to do, maybe behind the scene, not on the paper. So what you just need to do, you know that your opening stock will come here, and then from the question, your opening stock is what? Your opening stock is 20,000. And then you see purchase is already there. Purchase is there. Check through. Do you see carriage inwards? Yes. So you write your purchase. You can just write a P just to represent purchase because you don't have all the time. So your purchases is 168. You have 168,000. And then you add your carriage inwards. What is carriage inwards there? Carriage inwards is 500. Write it like you have 500 there. So when you add this, you have 168,500. Your carriage inwards, okay, your carriage inwards is 5,000, not 500, sorry. So you are going to have 168, this is 0, 0, 0, plus 5, you have 13, 3, you know, carry 1, this is 7, 173. That's what you are going to get. And then, is here return outwards? Is there return outwards? Yes, return outwards there is 8,000. Let's return outwards 8,000. 1, 2, 3. So you are going to subtract. You are going to subtract this. This is 0, 0, 0. Subtract 8 from 3. That cannot, you can't subtract that. So borrow 1 from 7 here. Borrow 1 from 7 here to be 13. When you subtract here from 8 from 13, you have 5. And then what will remain here is 6, and what will be here is 1. So you have 165,000. This 165,000, like I said from my illustration, is your net purchase. This will not be your net purchase. Now, having done that, this net purchase is to be added to your opening stock. Remember, what you are looking for is net profit. What is gross profit rather? So this will be added to this place. Let me write it in such a way that it will be easier to add. So we have 165, 1, 2, 3. When you add this to 20,000, you have 185, 1, 2, 3. Plus 20,000 is 185, 1, 2, 3. This is what we call your cost of goods available for sales. Cost of goods available for sales. Then you are going to subtract your closing stock. Less closing stock. What is closing stock in the question? Closing stock there is 48,900. 48,000. We have 48,900. Now, here minus here is 0. This 0 minus this 0 is 0. Now, 9 cannot be taken from here, from this other 0. What you do, so you borrow 1 from this 5 to make it 10. So 10 minus 9 is 1. And then here will remain 4. This 8 cannot be taken from 4. And then you take 1 from 8 here to make it 14. 14 minus 8 is 6. Here will remain 7. 7 minus 4 is 3. And here becomes 1. So your cost of goods sold, this is the value of closing stock. So your cost of goods sold is 136,100. Then your sales from the question is 183,400. And then, do we have return inwards? We have only carriage inwards. There is no return. Okay, there is return inwards. Return inwards is 10,000. Let's return inwards, which is what? 10,000. 1, 2, 3. So you are going to subtract now. Subtract this from here. 0, 0, 4, 3, 7, and what? 1. 173,400. That is your net sales. This is your net sales. So now to get your gross profit, which is expected in that question, is simply the difference between 136,100 and 173,400. So how do you do that? Let's come to this side and subtract. If you write 173,400 minus 136,100, what will it be? This is 0, 0, 3. 6 cannot be subtracted from 3. So what is going to happen is that you borrow 1 from here to make it 13. 13 minus 6 will give you what? 7. So now 6 will remain here. 3 minus 6 is 3. And then 1 minus 6. So your answer here is what? 37,300. 37,300. So your gross profit here, gross profit is equals to 37,300. So at the end of the day, you have something like 173,400, and then 173,400, 400. So the answer is 37,300. Do we have 37,300 there? That's the question we are going to ask. 37,300. Now, what we are having here is 37,200 instead of 37,300. Is it that we didn't get it when we were doing the subtraction? Now, the thing is that when you are doing your subtraction, you need to be very, very careful. By the time you solve like this, and then your answer does not correspond with the options, you go over it and check the figures. If the figures correspond with what you have, then something is wrong with the question. If we check what we have, and then we see that we have carefully written used all the figures, and we didn't make any mistake, then something is wrong with the question. Your opening stock is 20,000, and then your purchase is 168,000, and then your carriage inwards is 5,000. Okay, here plus here, you go over it again here like this. This is 13,000, carry 1, this is 7, and that's correct. Then you are return outwards, which is 8,000. Return outwards is 8,000. Return outwards is 8,000. 8,000 minus this is 0, this is 0, this is 0. Then 13 minus this is 5. And then 16, that's correct. Then your cost of goods available, here plus here, we give you this. Less closing stock, here is 0, here is 0, here is 10, 1, here remain 4, 14, here is 6, is 7, 3, and then we have 1. This is correct. And then coming down to this place, when you subtract this from this, when you subtract 160, let's do it again. 173,400 minus 136,100. You have 0, 0. This is here minus here. We give you 3. Here cannot be subtracted from here. From 1 to here, you take 1 from here to give you 13. 13 here minus 13, we give you 7. And then here will be 6. 6 minus 3 is 3. You can see that we arrive at 37,300. So 37,300 is the answer. Our questions here, the options they have here is not, this question have a challenge. Let's quickly look at another question. We have done that. So what you do in accounting, when you are attending to WAEC related question, don't be panic. Whenever you have done what you are supposed to do and your answer is not among the options, don't be panic. Provided you are very sure that the figures are correct, you are good to go. If it is theory, at this point, every examiner will mark you correct. But since it's OBJ, you don't need to be panic. Just move on. You go to the next question. They said the net profit is dash. The net profit is dash. Now we have gotten our gross profit to be 37,300. Now let's go over to the question again. In this question, if our gross profit is 37,300, the net profit is very simple. Net profit is simply gross profit minus your expenses. So if we have 37,300 as our gross profit, and then in the question you are giving 15,000 as expenses. You are giving 15,000. So you simply subtract 15,000 from this. 1, 2, 3. 15,000 from this is 0, 0. This is 3. And then this is 2. And then this is 2. Now the challenge we have with this question is that whenever the option is wrong for gross profit, it will affect net profit. Let's see if at the end of the day we'll be able to get the right, okay. The net profit there, our net profit is, you see, I said it. So it will affect the whole question. Now let's quickly go to another one. All right, this is another very interesting question that will also bring home what we are looking for. This one does not require to use this whole account. What you need at this point is just the formulas, how to be able to relate these transactions together. They say use the following information to answer 43 to 46. They have given you sales. They say sales is equal to what? 14,600. 14,600. And then purchase is equal to what? 5,500. And then return invoice. Return invoice is equal to what? Is equal to 150. And then the next one is salaries. Salaries is equals to what? 1,000. And then discount received, permit me to abbreviate that. Discount received is equal to, okay, I think I skipped rent. Rent is equal to what? 2,000. And then we have discount received. Discount received is equal to 400. And we have closing stock. Closing stock is equal to what? 250. And the last but not the least is opening stock. Opening stock is what? 100. And then they ask you the cost of goods sold. Now, cost of goods sold from what we have done so far is simply we are going to use a formula here. Net sales, we have what we call net sales minus Cost of goods sold is equal to what? Your gross profit. So your gross profit, net sales minus cost of goods sold, is equal to gross profit. Now look at the whole question. We have sales. We don't have cost of goods sold. We don't have gross profit. So what should I do? What I'm going to look for now, I'm going to look for these two. This is the two that I'm going to look for. If I'm not able to get this, this is what the question is looking for. If I can get any of this, then I am good to go. Now, opening stock is 1,000. So you have 1 is 100, which is your opening stock. Then plus purchase, which is what? Purchase is what? 5,000. 5,500. There is no carriage here. So your opening stock is 100 plus 5,500. This will give you 5,000 what? 600. Now, having arrived at this, subtract your closing stock from it. Closing stock less closing stock. Less closing stock, that's 250. This is 0. 10 minus 5 is 5. Here will remain 5. This is 5 minus here is 3, and here is 5. This will be your cost of goods sold. So we have gotten cost of goods sold here. We've gotten cost of goods. So your cost of goods sold from this question now is 5,350. That's option A. From the question now, your answer is A. This is your answer.